Please don't ask me to sing. I sing like a frog. So, uh, whatever you do with me for the next, I'm very scared of media. Do not ask me to sing at the end of these 30 minutes.
No, no, but we'll do a quick rapid fire.
You can do all the rapid fires. I think Karan Johar, I want to sue Karan Johar because he's popularized these rapid fires. And Karan Johar, when he does a rapid fire, he gives people these nice hampers. I mean, if you're answering all these questions, everyone is giving rapid fires with no hampers. But anyway, you can do it.
But we do have a token.
Achha, you have a token.
We do. So, but let's start with the big picture here. So, given the volatility we have I mean, it is now from a VUCA world, we have moved very seamlessly into a Barney world, right? The brittle, anxious, incomprehensible. So, and now but there is a ceasefire announcement, so to say. But how do you believe the market is going to perform from here, and what does investor sentiment look like to you?
So there is a old Urdu saying that हर किसी को मुकम्मल जहां नहीं मिलता, कभी जमीन नहीं मिलती, कभी आसमान नहीं मिलता. And I think in investing, conditions are never optimal, right? And we have a tendency as investors to look at the market as a collection of events. And the reality is, one event has happened. Trump is calm for now. A ceasefire has been announced. And so the immediate risk and negativity around oil prices, in particular, that impact India, is out of the way. But I would just caution you to say that doesn't mean that there is another event down the line. So I think investors, one, before coming to the current event, have to get used to the fact that investing is a series of short-term volatility and events, but hopefully a long-term journey. I always say that investing in India is a little bit like walking down a road where there is a pot of gold at the end of the road, right? So 5 years later, 10 years later, if you look at Indian equities, they have made money. 5 years later, 10 years later, if I look at the Indian economy, I think you will make money. But unfortunately or fortunately, like the roads of Mumbai, that road to the pot of gold is always under construction and full of potholes, and some flyover is broken and some accident is there. So yes, I think the immediate risk that came out of the event, with oil prices being below now or near 80, at least bodes well for India's macro. But I think geopolitical turbulence is increasingly becoming the reality of what we are going through. What my hope is that if you look at the current year, going into this year, pre the crisis, we actually thought that India would be a relative outperformer relative to the rest of the world, because earnings revival was starting to happen. In fact, if you look at February, FII flows had started to turn positive, and then this whole thing happened. So we think quarter one probably will be a tough quarter, but the market has sort of priced that in. And hopefully in the second half of the year, nothing else impending, you'll come back to an earnings recovery momentum.
But having said that, given mutual fund inflows in our country are still strong, still crossing the 30,000 crore mark. So, I mean, there has been some moderation, but given the macroeconomic events that we are seeing, how do you see this disconnect?
So I actually don't see it as a disconnect. I see it as something structurally very positive. And I must say, in the last 6 months, because returns have been more muted, it has become a little fashionable to make fun of SIPs. But the fact is, I joined the industry in 2017 when the national SIP book was a little over 3,000 crores. We are 10x from that level. So that means, and for most of my tenure, I have always heard that market correct hoga, SIP book will be vulnerable and fragile. And actually, despite some amount of stoppages that you're seeing, the SIP book seems to be in good shape. So I think domestic capital conditions continue to be strong. What gives me most heart is the behavior of retail. So if you look at the month of March, where markets fell by 12.5%, actually you got 60,000 crores of net money into equities, 40,000 came into long only equities. This is very, very heartening. So retail investors, instead of panicking at a time when the world was in crisis, entered at that time, and so far they've been proven right. So there is tremendous maturity in investor behavior and stability around that. Now, could 30 become 28 and 29? Perhaps. Is there always some element of froth in this? Perhaps. But will 30 become 15 overnight? I don't think so.
But having said that, like the maturity of the Indian investor, but we also see a lot of funds are going into small cap funds.
Yeah.
And usually in times of war, I mean, it's usually the large cap funds that are considered to be more stable. So how do you see this trend?
So I have a slightly contra perspective on this whole large, mid, small debate that happens in India. And we conveniently believe that large cap means safe and mid and small means volatile. Incidentally, in March and April, broader markets, which is your mid and small, fell less than large caps because earnings growth in the mid cap space is actually even better than large caps. Now, let's just break it down. India has a very, very unique way to classify market capitalization. Our market capitalization is rank based. So large cap company means 1 to 100 by market cap. The next 250 or the next 150 are mid caps. The balance is small caps. In most parts of the world, and I spent about half my career abroad, there is a market cap based definition. So large caps account for 95% of market capitalization. In India, large caps account for 65-70% of market capitalization, and that number is falling. Actually, if you look at the large cap index in India, it is a largely three sector index, that is banks, tech, and energy and metals. If you look at most themes that were to define the next 10 years of India, whether it is capital markets, whether it is hospitals, whether it is clean energy, whether it is premium consumption, most of these are present in the mid and small cap space. India's largest wealth manager is a mid cap company. India's largest pizza delivery chain is a mid cap company. One of India's largest listed exchanges was a mid cap company. So I think mid and small caps are a bit of a misnomer. And I don't think you can say large cap hai, to kam risky hai. Finally, you will be rewarded for earnings growth. And if mid and small caps, by the way, continue to deliver at a better pace on earnings growth, you will see that. By the way, FII capital has also shifted towards mid and small caps.
So where should investors then allocate their fresh capital?
So if I were to build a portfolio for the next 10 years, I would not build a pure large cap biased portfolio. I would build ideally a multi-cap portfolio that has some component of large, mid and small. At the minimum, large and mid. If some want to avoid small caps, then one can avoid small caps. But I would not build a top 100 portfolio. I would at least broaden the universe to top 50. Now, depending on who you are, that could be 60 large and 40 mid and small. My personal portfolio, by the way, is 30% large cap and 70% mid and small.
But you also have a 10 to 15% of your portfolio as international portfolio.
I do.
So, how much of international exposure should Indian investors ideally have? I mean, considering now with like Korea and Taiwan, they just, with the outperformance in the markets, and India has now moved a little below in the top, being the top economies.
So again, I'll give you some context here, because today everybody that you talk to is talking about international exposure. And I have a little bit of a long history here. And so just a personal story. So as I said, I started investing when I was in the US. And the base assumption that I was taught when I started investing is no matter how good an individual market is, even if it is a market like the US, you don't put all your money in that market because different markets do well at different points in time. So I remember moving back to India in 2009 and starting to invest in 2011 when I was a poor entrepreneur doing small SIPs, and I had nothing to do with Edelweiss or the mutual fund industry. One of the first things I did in 2011 outside of doing my basic Indian equity SIPs was go look for an international fund, was go look for a way to invest abroad. Now, at that point, I think there were 4 mutual funds that were available that had any kind of international investing involved. So there was a fund by Birla Mutual Fund called International Equity Fund, and I put 10% of my capital there. So fundamentally, the premise of having 10 to 15% of your portfolio abroad, I think, is a strong premise. And I think there are three reasons for it. One, as I said, different countries do well at different points in times. If you look at two major emerging markets, India and China, they are almost uncorrelated in when they do well, because people either allocate capital to India or they allocate to China. So very often with my China fund, I get the criticism कि आपका China fund अच्छा नहीं कर रहा, India बहुत अच्छा कर रहा है, and then I get the reverse criticism. The second is that I think if you look at India as an economy, while we are a very diversified economy, there are just many themes that are not reflected in the Indian economy today. Today, we are talking about the AI play or the semiconductor play not being reflected in Indian markets. But even a theme like deep healthcare research is just not reflected in our largest stock exchange till now is not a listed company, right? So many sectors are just not reflected. And third, and very few people like when I talk about this, there is an element of currency depreciation that you benefit from when you invest overseas. So I think overseas investing should be part of the portfolio. My only caution is you shouldn't do it because Korea and Taiwan made a lot of money in the last 1 year. I think when people tend to invest, and the mistake they make in global investing is they tend to be very tactical about it. So when India is doing well, we say home market bias, why do we need to go anywhere else? When the world is doing well, we say, why isn't India doing well? Why can't I access Korea and Taiwan? It's a principle of asset allocation. It should be 10 to 15% of your portfolio at all points in time.
But RBI has a certain threshold for international mutual fund investments, and that is consistently being breached over the last year. So what avenues does that leave investors here then?
I have to say, I think we are today of course, we hit the RBI limits, but we have a little bit of space. So we allow 5,000 rupees a day in all the Edelweiss international funds. If I tell you the number of consumers that invest in those international funds a month, despite the 5,000 rupee limit, and try to do this clever jugaad of doing a monthly SIP every day. I mean, it's a story for another day. It's absolutely hilarious. So that's the kind of demand. So I think GIFT will become a platform to invest abroad. We are very bullish about GIFT City as a platform. Today, we've offered one fund here, which is the Edelweiss Greater China Fund. So we allow people to invest in the Greater China market. I foresee by the end of the year, as Edelweiss itself, we will be able to offer you access to 6-7 funds out of GIFT, most of the major geographies. And I think our greatest challenge is when you invest locally, pre-RBI limits, the experience is very seamless. You can do it like this. We now want to make the digital experience very seamless. We've already started with China. But by the end of the year, I think you will have a lot more options available out of GIFT.
Can you talk to us about these funds from GIFT City, and what are the problems that these funds are trying to address or solve rather for Indian investors?
So I think GIFT as a platform can solve two problems for investors. One is for inbound investors and one is for outbound investors. For outbound investors, as I said, access to global markets is a problem. The RBI limits are closed. Of course, you have the option to buy stocks or ETFs directly through some platforms that are enabling you to do global investing. But it's hard enough to do research on Indian equities that I have to sit and decide which companies to buy in China and which companies to buy in Taiwan. So I think with us, for instance, we partner with JP Morgan. We don't manage global money ourselves because we don't have the expertise to do it. But we are providing you access to some of the best managers overseas and giving you that. The second problem that I think GIFT will solve, which I hope is a big one, is the NRI opportunity. I think we as a country need a lot more foreign capital to come. NRIs have had the option to invest in India via the mutual fund route, but then they have to have the whole setup in India. I think inbound via GIFT. So we've set up one fund that is a multi-manager fund that allows people to access a basket of Indian funds. So I think GIFT solves problems for the NRI. It solves problems for the resident Indian also.
And there's also this newly introduced SIFs, Specialized Investment Fund. Edelweiss also has one, and I do believe they're performing exceptionally well. So, what do you think is driving investor interest in specialized investment funds?
So I have to say, I think the SIF asset class was introduced by SEBI I would say sometime in August, and we were one of the first launches in October. Um, our SIF platform today, which is the largest in India, is already 5,500 crores when hardly any distribution for this platform has been created. So I am positively amazed by the speed and scale at which investors are looking at new investment options. And I really must thank the regulators and also folks like NSE for having this vibrant derivatives market that has enabled all of this. So I think go back to a year ago and you had investment management divided into two distinct options for investors. There were mutual funds where fundamentally you were a long only investor. You could benefit only if markets did well. If markets did poorly, if a stock did poorly, there wasn't any way to benefit. And then you had things like AIF and PMS, which were for the 50 lakh, 1 crore investor. And to be honest, not the most tax efficient platforms. And I started my career on the AIF and PMS platform. Now you've created SIF, which is a platform which has the flexibility of AIF and PMS, particularly around derivative usage, but it has the operational infrastructure, tax infrastructure of mutual fund, and lo and behold, the ticket size is 10 lakhs. So sophisticated investment strategies that were available to the ultra high net worth are now available to the mass affluent. Now, I think again, going back to investor need, one very common need is fixed income. For all the investment we do in equity, everyone wants stable return portfolios. In the current tax regime, if you see mutual fund flows into fixed income, if I ask this audience, how many of you invest outright into fixed income? Most people will not raise their hand because they will say taxation is a huge problem. Can you now, using arbitrage, fixed income, and some smart derivative strategies, create products that can deliver you maybe 9 to 10% pre-tax and 8% post-tax, and suddenly a whole asset class gets created for consumers and you see the scale. So I'm very, very bullish on the SIF platform. I think it could be a very, very large business for us going forward.
Even bond yields have been moving higher. So, I mean, if you have to give some advice, what should be investors' fixed income strategy then?
So I think it's a very uncertain time for the bond market. If I had to advise investors, given that you have global yields at 5% and likely, if you look at the spread between US bond yields and India bond yields today, it is at historic lows. So if I have to reckon a guess, India bonds are likely to move up. So I would tell investors not to take too much bond risk, sit at the short end of the curve and look for tax efficient fixed income options. If an arbitrage fund solves your problem, then an arbitrage fund. Otherwise, if a hybrid SIF solves your problem, hybrid SIF. But I don't think this is the time to take duration risk.
Okay, so if I was an investor who's extremely risk averse and I'm building my portfolio today, what should I look at?
If you're an investor who's extremely risk averse, I would buy a combination of hybrid funds. I think hybrid funds are kind of like the khichdi of Indian mutual funds, and I say khichdi in a good way. They incorporate multiple dietary elements into a single meal that is efficient to cook, and it's like a one pot meal. So I would buy a hybrid specialized investment fund, I would buy an equity savings fund, I would buy a multi-asset fund, I would buy a balanced advantage fund. No matter how conservative you are, you still want some element of absolute return. You also want it in a tax efficient way, but you don't want to see your portfolio down 20%. So I would build a portfolio where the core is anchored around hybrid funds.
And what about a person who start building the portfolio from scratch but has a good risk appetite?
So again, if you're building something from scratch, I'm a big believer in the thali concept, and as you can see, I'm obsessed with food because everything I talk about is food. So I would build your thali. A dominant portion of your thali will be multi-cap equities. And as I said, I'm a strong believer that mid and small cap needs to be a meaningful part of that. I would keep some space for fixed income and gold because I'm a big believer in diversification. And I would add some exposure to international markets, probably 10 to 15%.
And you have spoken briefly earlier about India as a market, but can you, I would still want to ask you this question about your view on India as a global investment or long-term investment destination.
Look, I am the greatest advocate for long India, and I always tell people my greatest advocacy is that I left the US in 2009 to move back, and till date I rate that as the best investment call of my life. So I'm the greatest advocate for long India. I think my point of view on India hasn't changed, but I think our point of view changes. So in 2024, when markets were where they were, I think there was a lot of optimism. 2 years later, because Korea and Taiwan have done well, and suddenly we've discovered TSMC and Japan has done well, we're starting to question the India thesis. And I don't think we should question the thesis so much. I think if I objectively look at us as a country, we continue to grow at 6 to 7%. We could grow at 8%, but we continue to grow at 6 to 7%. And I think that makes us one of the fastest growing major economies in the world. Growing at, early double digit nominal growth when you are valued at 35, 40 PE is not great. But when multiples have corrected and earnings can grow, it's not so bad. So I think we continue to be that. I would go back to a quote Mike Milken had, where he said that every time I see a US company and an American CEO is replaced by an Indian CEO, I feel optimistic about that country. And by the way, someone actually backtested that thesis and realized that if you replace an American CEO with an Indian CEO, you actually have meaningful alpha over the S&P 500. So I think Indian entrepreneurship is unquestionably outstanding. So I continue to be a bull on Indian entrepreneurship. And I continue to be a bull on demographics for the next 20 years. So we have the ingredients. There are things we have to get right. I think we still are not a product nation. We have a lot more to do in terms of R&D spend. Ease of doing business has to get better. So there are a lot of things that we have to get right. But we continue to be one of the fastest growing major economies in the world. That thesis has not changed.
In that context, which sectors? Okay, that's a very cliched question, but it is a must ask.
It's a very cliched question.
Yes, but I have to ask, which sectors do you think will drive earnings in the next few years?
So for all the criticisms leveled, I think the best thing about the structure of the Indian economy and the structure of the Indian market is that it is a multi-sector economy, which is why I find it's a very cliched question. How much of Taiwan is driven by TSMC? How much of Korea is driven by Samsung? Here in our indices, I think the largest weight is 10% in a single company. And when I meet promoters, when I meet entrepreneurs, if you talk to, I was in a meeting with a group of entrepreneurs. Someone came yesterday from the shoe business and they told me shoe penetration in India is 2 versus 6 globally. I was with someone in the services business and they said 70% of the market is unorganized. I was with someone in the chemical business and they were optimistic, and I'm in the capital markets business and I can tell you I'm optimistic. Now, if you are to ask me for sectors that we are currently excited about, I would start by saying capital markets and financials. We do see credit growth coming back. And so we see the banking side of the business doing well. And we continue to be very optimistic about our own business, that is capital markets. I'm sitting with one of the largest potential listed capital markets companies. So that's one. I think India's power needs. We have a serious power deficit. So I think power and defense are ones that we continue to be optimistic about. And if this crisis has taught anyone anything, it is that you have to keep investing in your defense capabilities and in your energy capabilities. And I think the whole element of premiumization of consumption, even today, for instance, if you look at a sector like hotels, our bed capacity per 1,000 people is 1/5 of China. The same thing is true of hospitals. So the whole element of premium consumption.
There's this one trend about how women are actually now coming up and investing, and from 2 to 3% of demat accounts, they now own up to 30%.
Yeah.
I mean, while the numbers are phenomenal, of course, but how do you see this trend? Because a lot of times we also hear that all these accounts are managed by their husbands and fathers and brothers.
So I'll tell you the more optimistic statistic. And before I was doing this,
Give me a realistic.
no, I'll give you realistic numbers, right? If you look at mutual fund folios, 25% of them belong to women.
Yeah.
But if you look at new additions, 35% are by women. If you look at a brand like ours, and we haven't done too many Women's Day campaigns, 35% of our consumers are women.
Wow. Okay.
And it's probably one of the highest in the industry. And I agree, some of these accounts will be managed by fathers, husbands, etc. But if you look at a younger generation of women, women under 35, and Amphi releases this data, they are one of the fastest growing cohorts of investors. So a younger generation of women has more access, is more enabled, wants to be more independent. And I'll tell you something very interesting. I was doing a session for a bunch of women at Kotak right before this. In the last 18 months, every day I get a session from a random group of 10 women, would be economically very well off, saying, just teach us something about financial literacy. So I think the movement is here, it has started, and we should stop this narrative that women can't invest. For decades and decades and centuries, mothers, mother-in-laws, nannies, daddies have been the CFOs of the homes. And we have done that without any press releases and Excel spreadsheets. So we've been damn good CFOs and savers. Translation to investments is happening. So give us a break and make a few movies, man, where women in finance are lead characters, not men.
That's I mean, after this Titan movie now, I think that's something we need to really think about. Okay, so give me top 3 or 4 most important things investors now need to keep in mind while building portfolios.
So I think investors should, I have a small framework that I think works, and it's called BAT. BAT. So B stands for beta, which is just participation in the market. So I think it's important for investors to participate in the market. But I think we're also transitioning from a slightly high return environment to a more volatile and low return environment. The 2 other elements in this framework are A, alpha, and B, T, which is tax efficiency. In a high return environment, all that matters is you're participating in markets. Whether you're doing it tax efficiently, whether you're rebalancing, whether you're getting alpha, doesn't matter when market returns are 30-40% in a year. When you start to move into a 10-12% return environment, I think participation has to be supplemented with precision. So you have to be a lot more precise in building portfolios. Are you doing things in an efficient way? Are you investing in things that are getting alpha? Instead of earning 10% by directly investing in equities, can you do it through a hybrid fund where the cost of that beta is a lot lower? So I think the theme is participation should give way to a little more precision in portfolios.
Okay. So since I promised we have a quick rapid fire, so tea or coffee?
Only coffee.
Old or new movies?
Old.
Any dialogue you remember from your favorite Bollywood movie?
Oh, I have thousands of them.
Your favorite one?
I think it's very applicable to markets. So please don't judge me. But my favorite actor has and always will be Shah Rukh Khan. And I like the Shah Rukh Khan old movies. I don't like the new ones. But I think the most iconic one for markets, which is true, is कि बड़े-बड़े देशों में छोटी-छोटी बातें होती रहती हैं. So बड़े-बड़े निवेशों में भी छोटे-छोटे इवेंट होते रहते हैं. कभी ट्रम्प, कभी कुछ और.
And women in boardroom in Western sari or in a Western wear or a sari?
But do you need to ask me?
I mean, by the way, you're wearing a fabulous sari. It's not embroidered, it's hand painted.
It's actually
gorgeous.
Painted. Nari in a sari, sab pe bhari. And by the way, I must tell you, this is a tribute to Indian artistry. Some lady has actually painted every piece of this cloth by hand. She's an artist who paints saris. This is the kind of talent and craft we have in this country.
I'm sure. I mean, it would have come in video. I was looking at it and smiling.
Someone's actually painted it.
Yeah, it's gorgeous. And mountains or beaches?
Both, yeah.
Okay, so sari from a designer.
And India has both, by the way. I think if I had to quit financial services, I would either run a sari business or run tourism for the country.
Okay, startups in India or US?
Actually, both. But I think I don't invest in US startups. I'm an investor in Indian startups, and it's one of the most exhilarating things to do.
Okay, so thank you. So that will be all, and we did exceed our time. So, but it was a wonderful conversation. I really enjoyed this chat, and I hope you did too. So
Thank you.
thanks
Thank
so
you so
much.
much.